Hey guys, hope you had a great Christmas, managed to spend it with family and loved ones, and you had an amazing time. Now, 2026 is soon upon us. So, in this video, I'm going to talk about 6 of my favorite ETFs in the high yield space, in the income space, that I think will perform pretty well during 2026 and will be good to keep an eye on. So, that's what I'm going to get into. Of course, before we do, there is a disclaimer: this video is not financial advice. This channel is purely based on my thoughts as I navigate my own personal investment journey. Please always do your own research. So let's just get straight into it. Number one of my favorite ETFs from Roundhill is WHO, HOOW. It is a weekly pay ETF from Roundhill, so it's leveraged 1.2x, 120%. So that means if it goes up 10%, you're going to go up 12%. If Robinhood, the underlying, goes down 10%, you're going to go down 12%. So there's a lot more risk involved, but it is uncapped upside, which I like about it. It's also a weekly ETF, and it is currently distributing 84%, so a very high yield at the moment. Now, let's take a closer look at what who's doing. So let's just put it on 6 months. For the last 6 months, and total returns is up 45%. At its top in October, it was up 102%. So we are dipping quite a bit. If we go to the chart, you will see that we had a high on HOOW of $70, and we're now down at $51. So in my opinion, this is a pretty good price point. It's a pretty good entry point. If you're looking to get into it, I think this, anything under 52, probably 54, down to here, this zone, I would consider a buy zone. I'm still adding into it, DCAing into this position, and I think Robinhood will do very well in 2026, and I think this will continue to pay good distributions, and it should recover up to these highs at some point once liquidity starts coming back into the market, and the market starts doing better again. So that's my first one, is HOOW. Number two, CHPY, CHPY from YieldMax. This is my favorite YieldMax ETF. It doesn't pay super high distributions. It only pays 40%, and that's what I really like about it, because it's then able to recover its share price better. It's more sustainable, and it is just a good basket ETF of semiconductors. So it's basically AI semiconductor ETF with a basket of holdings, and it performs really well. Now let's have a look. If we add in CHPY into here, and we'll see for that same 6 month time range, this is total returns is up 27%. But you can see it just slowly, it's not as volatile as Robinhood, as WHO, but it's just consistently going up. And that's if we do price change, you'll see that WHO is down in terms of price, but CHPY is much more stable. It's up 3% in terms of price, even though we've had a bit of a bad few weeks from November. And if we go total return, of course, 45% for WHO, 27% for CHPY. Now, if we look at CHPY on here on the charts, you will see that, WHO, Robinhood's pretty volatile. It's down at the moment. But CHPY over that same time range, look at that. It's a really nice chart. It's just going up and to the right. Okay, there's a bit of volatility. We had a bit of a sell-off in November, but it's now recovered really nicely already. So for me, CHPY, it's one of my favorite ETFs. It gives you a solid distribution rate of 40%, but that allows it to recover and keep the share price and NAV erosion away. Its NAV is still NAV is positive. So I really like that, and I think its holdings within that semiconductor AI space are really good, and I think they will do well in 2026. So that's why it makes my list of the top 6. So that's number 2. What is number 3? It is BLOX. This gets quite a bit of talk around town in the high yield space, and it's not been doing too well because it's a crypto ETF. It is the Nicholas Crypto Income ETF, and it's mainly based on Bitcoin and Ethereum, but it also holds crypto industry companies. It's, again, a weekly ETF, and I think it distributes around 30%, 36% distribution rate. So similar to that chippy, it's not too high. So it's trying to have decent distribution, but it's not going for that 80, 90, 100% where it's going to struggle to recover, especially with Bitcoin and crypto being so volatile. And especially now when crypto is really down at the moment and BLOX has been holding up very nicely. But if we go down, we'll see the holdings, and you'll see that, oh no, it's not there. It's up here a bit. So you can see Ethereum is quite a large holding, over 8%. That's Ethereum, HUD 8. That's more Bitcoin mining. There's a lot of Bitcoin mining in here, but there's also NVIDIA. So that's kind of a strange one. But it's mainly, look, Coinbase. So that's an exchange, Bitcoin mining, Ethereum. But if we look at the chart, we'll add BLOX here. We're in total return for the last 6 months, and let's see what it's doing. Last 6 months, 5.92%. Now, you may think that's bad, but that is, considering the state of crypto right now, that is pretty amazing. A few months ago, start of October, it was up 49%, and we're still in the green in terms of total return, which I think is pretty incredible. And I think it's just a great opportunity. Bitcoin's at around 86, 87, 88,000 at the moment. Ethereum's down, Solana's down. All the Bitcoin mining companies are obviously also down because Bitcoin is in this kind of low phase, this downward trend at the moment. Well, it's not a downward trend, but I think it's kind of bottomed out. So if you look at this, like, we've just been consolidating around this 85,000 mark for a couple of months, or almost a couple of months now, and we're off all-time highs. So everything else is ripping. So the Nasdaq is almost at all-time highs. The S&P is almost at all-time highs. Silver and gold are absolutely ripping. These are all, look at silver. I mean, it's just nuts. Look at gold, crazy. For me, it's not the time to get into these commodities because they are pumping so much. I think the rotation will happen soon, and Bitcoin is the one asset that hasn't been pumping. It's not at all-time highs. And I think since this has been consolidating quite nicely in this 85, 86, 87K range, I think now is a pretty good time to get into BLOX. And I think 2026 will be a good year for Bitcoin and for crypto. So that's why it makes my number 3 ETF on this list. But of course, if you're not bullish on crypto, if there's a lot of fear in the crypto space at the moment. So if you think it's a scam and really think you were going to have a huge bear market in 2026, then definitely don't get into BLOX, because it won't be a pretty sight if you think we're going into a proper bear market. I don't. I think liquidity is coming. I think 2026 will be good for Bitcoin and for crypto. Anyway, number 4, NVII. This is the NVIDIA Growth and Income ETF from REXSHARES. REXSHARES is one of my favorite fund managers companies, and it pays a distribution rate of 42%. Again, I think it's 40 to 60, 40 to 30 to 70% distribution rate range is really good. I think that allows the ETF, the fund, to recover. It's not paying crazy high distributions of 80% and above. So you're able to have a more stable NAV, a more stable share price, stay in the green in terms of share price and NAV, as well as have a decent distribution. Again, it's a weekly ETF. It's half uncapped upside potential, which I really like, and then the half weekly income via cover call strategy. But it is there is leverage, and it's between 105 and 150%. So you've got to bear that in mind. There is a bit of leverage in it, but it allows you to have that kind of uncapped upside potential as well as the income potential as well. But it's not as leveraged as the Roundhill ETF. So if you want to be it's a bit more conservative than NVDW. It's not going to go down 12% if NVIDIA goes down 10%. But on the upside, it's also going to capture some nice upside as well. So if we look at that in terms of performance, we'll add NVII here for the last 6 months and see how it's performed in terms of total. And it's up 30% in the last 6 months. But again, of course, NVIDIA is down a little bit at the moment. So at its top, it was up at 39.4, 40% basically. If we go to NVII on the chart, let's have a quick look and see. This is TradingView, by the way. I get a few questions about this sometimes, but this is TradingView. I have a paid subscription, but you can use this for free. But the paid lets you have all these watch lists. If you'll see here, I've got all my YieldMax ETFs. I've got the Roundhill, I've got Rex, I've got NEOS Curve, all the high yield, and then I've got like stocks and crypto in here as well. So you can just easily get to them. But if you look at NVII, we've had a bit of a dip. It was up at 31. We had a bit of a sell-off around November, early December, and it's now just slowly recovering. I think it's still a pretty good entry. I think NVIDIA will still do very well in 2026. It really is the heartbeat of AI, and the money just flows in and out of NVIDIA, and it's just all being held up. If you think there's an AI bubble, and that's your thesis, then don't get into it. But I think NVIDIA will have a very good year this year. So that is my number 4, NVII from REXSHARES. Right, number 5, TDAQ. This is a NASDAQ 100 growth and daily income ETF from the guys at Tap Alpha. Probably not so largely known as one of the companies in the high yield space, but I got into it fairly recently, a couple of weeks ago, after doing some more research and for wanting a bit more stable growth, a bit less NAV erosion, and I just wanted a decent fund with decent exposure to the NASDAQ 100, but also with a decent distribution rate. Now, there are funds that pay a higher distribution rate than this, like your QDTEs, your QDTY, I think, is the one from YieldMax, and they pay more like 30-40%. So you could look to get into those ones if you want a high distribution. But TDAQ has a better NAV. So its share price is better in terms of its performance of its share price, but it also pays out 17%. And it's based on a zero DTE strategy. So it's income generation maximized, time decay, but it also has that growth in terms of share price. So if we look at it from here, we'll just add TDAQ to the chart and we'll go. TDAQ's actually only been launched for a few months. So it's up 10.6% in terms of total returns over the last 3 months. And then if you look at price change, it is up the most, 5.95%. Obviously, the last couple of months have not been so good. You can see from the chart, we're in this we haven't really recovered out of this bottoming out period at the moment since that November, early December sell-off. But if you look up here, everything was in the green. TDAQ had only just launched in September, but it's already doing very well. It's going to be a lot more stable than any of these other ETFs, and it's just going to pay you a decent 17%. It's nothing fancy, it's nothing amazing, but if you buy on red days, you can pretty much be sure that you're going to be up in terms of share price by the end of the year, and you'll have a 17% distribution income from that as well. So it's a little bit safer, and that's what I'm trying to do. Less crypto exposure, because I've suffered in 2025 from the amount of crypto exposure I've had, and going a bit more into some of the safer, more stable in terms of NAV and share price income ETFs. So that's why TDAQ makes my list for number 5. And then number 6, AMZW. Now this might be a bit of a black horse. You might not expect it. It doesn't get talked about a lot. It is, of course, the Amazon weekly pay ETF from Roundhill. It pays a nice 40% distribution rate. And I just think Amazon is going to do really well this year in 2026. It's going to benefit a lot from AI and humanoid robotics. And Amazon has not been doing too well. Let's first have a look at the AMZW ETF. We'll go to total return, and it is only up 9%. And that's because the underlying will just go down to the stocks, where is Amazon, and you'll see that over the last year, Amazon is barely up. I mean, it launched the year at 227 and we're now at 232. But I think in terms of price and performance for 2026, Amazon is going to have a great year. As I mentioned, it hasn't done much in terms of price this year, but I think it's all set for a rally. If we look at Trading View and we go and have a look at what Amazon is doing, hold on. Just want to go back here. Bear with me a second. And we go to forecasts. This is a nice little thing. So if you go to Trading View and you have a look at if you can basically put in any stock in here in the search bar, find it. So Amazon, and we are down below every projection from analysts, right? So it's in a strong buy analyst rating. This is from 74 analyst ratings saying that it's a strong buy. 61 are saying it's a strong buy. 10 are saying it's a buy and 3 are saying it's a hold. And it's got price targets of between 250 and 360. We're now at a current price of 232. So it's got an average price target of 297. That's a big upside. That's almost a 30% increase from where we are now. And I think Amazon has not had a great year. As you can see, it's just not done much in 2025. But I think 2026, from the research that I've done, from everything that's going to happen with tech, AI, humanoid robotics, but not just that, in terms of the money that Amazon makes as a company, it's incredible. So I think Amazon is due for a decent rally this year, and that's why it makes maybe a bit of a black horse, because it's not one of the funds that everyone talks about in the high yield ETF space, but I think it's going to have a very good year. So that's why AMZW makes my 6th place spot. Of course, it's a bit risky because it's a 1.2 times 120% leveraged ETF. So if Amazon goes up 100%, then AMZW will go up 120%, minus the distributions that are coming out of the ETF, of course. So it's not going to go up a net 120%. But if it goes down 100%, it's going to go down 120%. So there's that risk, that leverage. But I think with something, Amazon, the MAG 7, ETFs aren't super volatile because they're such big, mega cap tech stocks. It's not hugely volatile. It's not like crypto or Robinhood or anything like that. So it's not going to have huge downside, in my opinion. So I think going with the leverage with the Roundhill Weekly Pay ETF, AMZW, I think it will do pretty well in 2026, and that's why it makes my number 6 spot. So anyway, there's my 6. So we've added them all. We've got Who, we've got CHPY, we've got BLOX, we've got NVII, we've got TDAQ, and we've got AMZW. And from a total return, they're all in the green for 2025. But we are in this, have had this bit of a sell-off in November, early December, and we are on the road back to recovery. And I think all of these will do well in 2026. So that's my list of 6. Let me know what you think in the comments. If you agree with this, if you would completely change these and go with some different ETFs altogether, I'd love to know what you think is going to do well in 2026. So please let me know in the comments. And I hope that was of some value. And I will see you in the next one, whether that's in the new year or not. If I do one before New Year, I'm not sure. I'll see. But anyway, thanks for listening, guys. And I'll see you in the next one. Cheers.